In mathematical finance, the Greeks are the quantities representing the sensitivity of the price of derivatives such as options to a change in underlying parameters on which the value of an instrument or portfolio of financial instruments is dependent. The name is used because the most common of these sensitivities are often denoted by Greek letters. Collectively, these have also been called the risk sensitivities, risk measures, or hedge parameters. Use of the Greeks. The Greeks are vital tools in risk management. Each Greek measures the sensitivity of the value of a portfolio to a small change in a given underlying parameter, so that component risks may be treated in isolation, and the portfolio rebalanced accordingly to achieve a desired exposure. See for example delta hedging. The Greeks in the Blacker-Scholes model are relatively easy to calculate, a desirable property of financial models, and are very useful for derivatives traders, especially those who seek to hedge their portfolios from adverse changes in market conditions. For this reason, those Greeks which are particularly useful for hedging delta, theta, and vega are well defined for measuring changes in price, time and volatility. Although ρ is a primary input into the Blacker-Scholes model, the overall impact on the value of an option corresponding to changes in the risk-free interest rate is generally insignificant, and therefore higher-order derivatives involving the risk-free interest rate are not common. The most common of the Greeks are the first-order derivatives, delta, vega, theta and ρ, as well as gamma, a second-order derivative of the value function. The remaining sensitivities in this list are common enough that they have common names, but this list is by no means exhaustive. First-order Greeks, delta measures the rate of change of option value with respect to changes in the underlying asset's price. Delta is the first derivative of the value of the option with respect to the underlying instrument's price. Practical use: for a vanilla option, delta will be a number between 0.0 and 1.0 for a long call and 0.0 and a 1.0 for a long put. Depending on price, a call option behaves as if one owns one share of the underlying stock, or owns nothing, or something in between, and conversely for a put option. The difference of the delta of a call and the delta of a put at the same strike is close to but not in general equal to 1, but instead is equal to the inverse of the discount factor. By put-to-euro-call parity, longer call and shorter put equals a forward F, which is linear in the spot S, with factor the inverse of the discount factor, so the derivative dfds is this factor. These numbers are commonly presented as a percentage of the total number of shares represented by the option contract, S. This is convenient because the option will behave like the number of shares indicated by the delta. For example, if a portfolio of 100 American call options on XYZ each have a delta of 0.25, it will gain or lose value just like 25 shares of XYZ as the price changes for small price movements. The sign and percentage are often dropped to euro. The sign is implicit in the option type and the percentage is understood. The most commonly quoted are 25 delta put, 50 delta put/50 delta call, and 25 delta call. 50 delta put and 50 delta call are not quite identical, due to spot and forward differing by the discount factor, but they are often conflated. Delta is always positive for long calls and negative for long puts. The total delta of a complex portfolio of positions on the same underlying asset can be calculated by simply taking the sum of the deltas for each individual position. A euro delta of a portfolio is linear in the constituents. Since the delta of underlying asset is always 1.0, the trader could delta hedge his entire position in the underlying by buying or shorting the number of shares indicated by the total delta. For example, if the delta of a portfolio of options in XYZ is plus 2.75, the trader would be able to delta hedge the portfolio by selling short 2.75 shares of the underlying. This portfolio will then retain its total value regardless of which direction the price of XYZ moves, as a proxy for probability. The delta is close to, but not identical with, the percent moneyness of an option, that is, the implied probability that the option will expire in the money. For this reason some option traders use the absolute value of delta as an approximation for percent moneyness. For example, if an out-of-the-money call option has a delta of 0.15, the trader might estimate that the option has approximately a 15% chance of expiring in the money. Similarly, if a put contract has a delta of a 0.25, the trader might expect the option to have a 25% probability of expiring in the money. At the money, puts and calls have a delta of approximately 0.5 and a 0.5 respectively, with a slight bias towards higher deltas for ATM calls, that is, both have approximately a 50% chance of expiring in the money. The correct, exact calculation for the probability of an option finishing at a particular price of K is its dual delta, which is the first derivative of option price with respect to strike. Relationship between call and put delta. Given a European call and put option for the same underlying, strike price and time to maturity, and with no dividend yield, the sum of the absolute values of the delta of each option will be 1.00 euro. More precisely, the delta of the call minus the delta of the put equals 1. This is due to put a euro call parity, a long call plus a short put replicates a forward, which has delta equal to 1. If the value of delta for an option is known, one can compute the value of the delta of the option of the same strike price, underlying and maturity but opposite right by subtracting 1 from a known call delta or adding 1 to a known put delta. D, call, AD, put, equals 1, therefore, D, call, equals D, put, plus 1 and D, put, equals D, call, a 1. For example, if the delta of a call is 0.42, then one can compute the delta of the corresponding put at the same strike price by 0.42 AAA1 equals AA 0.58. To derive the delta of a call from a put, one can similarly take a 0.58 and add 1 to get 0.42. Vega. Vega measures sensitivity to volatility. Vega is the derivative of the option value with respect to the volatility of the underlying asset. Vega is not the name of any Greek letter. However, the glyph used is the Greek letter mu. Presumably the name Vega was adopted because the Greek letter nu looked like a Latin V, and Vega was derived from V by analogy with how beta, eta, and theta are pronounced in American English. Another possibility is that it is named after Joseph de la Vega, famous for Confusion of Confusions, a book about stock markets in which discusses trading operations that were complex, involving both options and forward trades. The symbol kappa is sometimes used instead of Vega or capital lambda, though these are rare. Vega is typically expressed as the amount of money per underlying share that the option's value will gain or lose as volatility rises or falls by 1%. Vega can be an important Greek to monitor for an option trader, especially in volatile markets, since the value of some option strategies can be particularly sensitive to changes in volatility. The value of an option straddle, for example, is extremely dependent on changes to volatility. Theta measures the sensitivity of the value of the derivative to the passage of time, the time decay. The mathematical result of the formula for theta is expressed in value per year. By convention, it is usual to divide the result by the number of days in a year, to arrive at the amount of money per share of the underlying that the option loses in one day. Theta is almost always negative for long calls and puts and positive for short calls and puts. An exception is a deep-in-the-money European put. The total theta for a portfolio of options can be determined by summing the thetas for each individual position. The value of an option can be analyzed into two parts, the intrinsic value and the time value. The intrinsic value is the amount of money you would gain if you exercised the option immediately. So a call with strike $50 on a stock with price $60 would have intrinsic value of $10, whereas the corresponding put would have zero intrinsic value. The time value is the value of having the option of waiting longer before deciding to exercise. Even a deeply out-of-the-money put will be worth something, as there is some chance the stock price will fall below the strike before the expiry date. However, as time approaches maturity, there is less chance of this happening, so the time value of an option is decreasing with time. Thus, if you are long an option, you are short theta, your portfolio will lose value with the passage of time. Rho measures sensitivity to the interest rate. It is the derivative of the option value with respect to the risk-free interest rate. Except under extreme circumstances, the value of an option is less sensitive to changes in the risk-free interest rate than to changes in other parameters. For this reason, ρ is the least used of the first-order Greeks. ρ is typically expressed as the amount of money, per share of the underlying, that the value of the option will gain or lose as the risk-free interest rate rises or falls by 1.0% per annum. Lambda, omega, or elasticity is the percentage change in option value per percentage change in the underlying price, a measure of leverage, sometimes called gearing. Second-order Greeks. Gamma measures the rate of change in the delta with respect to changes in the underlying price. Gamma is the second derivative of the value function with respect to the underlying price. All long options have positive gamma and all short options have negative gamma. Long options have a positive relationship with gamma because as price increases, gamma increases up as well, causing delta to approach 1 from 0 and 0 from -1. The inverse is true for short options. Gamma is greatest approximately at the money and diminishes the further out you go either in the money or out of the money. Gamma is important because it corrects for the convexity of value. When a trader seeks to establish an effective delta hedge for a portfolio, the trader may also seek to neutralize the portfolio's gamma, as this will ensure that the hedge will be effective over a wider range of underlying price movements. However, in neutralizing the gamma of a portfolio, alpha is reduced. Vanna, also referred to as Vega spot and delta vol, is a second-order derivative of the option value, once to the underlying spot price and once to volatility. It is mathematically equivalent to delta vol, the sensitivity of the option delta with respect to change in volatility. Or alternatively, the partial of Vega with respect to the underlying instrument's price. Vanna can be a useful sensitivity to monitor when maintaining a delta or Vega hedged portfolio, as Vanna will help the trader to anticipate changes to the effectiveness of a delta hedge as volatility changes or the effectiveness of a Vega hedge against change in the underlying spot price. If the underlying value has continuous second partial derivatives, then Vomma, Volga, Vega convexity, Vega gamma or d tau d vol measures second-order sensitivity to volatility. Vomma is the second derivative of the option value with respect to the volatility, or, stated another way, Vomma measures the rate of change to Vega as volatility changes. With positive Vomma, a position will become long Vega as implied volatility increases and short Vega as it decreases, which can be scalped in a way analogous to long gamma. And an initially Vega neutral, long Vomma position can be constructed from ratios of options at different strikes. Vomma is positive for options away from the money, and initially increases with distance from the money. Charm or delta decay, measures the instantaneous rate of change of delta over the passage of time. Charm has also been called denoted time. Charm can be an important Greek to monitor when delta hedging a position over a weekend. Charm is a second-order derivative of the option value, once to price and once to the passage of time. It is also then the derivative of theta with respect to the underlying's price. The mathematical result of the formula for charm is expressed in delta year. It is often useful to divide this by the number of days per year to arrive at the delta decay per day. This use is fairly accurate when the number of days remaining until option expiration is large. When an option nears expiration, charm itself may change quickly, rendering full-day estimates of delta decay inaccurate. Vega, or Vega Time, measures the rate of change in the Vega with respect to the passage of time. Vega is the second derivative of the value function. Once to volatility and once to time. It is common practice to divide the mathematical result of Vega by 100 times the number of days per year to reduce the value to the percentage change in Vega per 1 day. Vera measures the rate of change in ρ with respect to volatility. Vera is the second derivative of the value function. Once to volatility and once to interest rate. Vera can be used to assess the impact of volatility change on ρ hedging. Third-order Greeks, color, gamma decay or gamma time measures the rate of change of gamma over the passage of time. Color is a third-order derivative of the option value, twice to underlying asset price and once to time. Color can be an important sensitivity to monitor when maintaining a gamma-hedged portfolio, as it can help the trader to anticipate the effectiveness of the hedge as time passes. The mathematical result of the formula for color is expressed in gamma year. It is often useful to divide this by the number of days per year to arrive at the change in gamma per day. This use is fairly accurate when the number of days remaining until option expiration is large. When an option nears expiration, color itself may change quickly, rendering full-day estimates of gamma change inaccurate. Speed measures the rate of change in gamma with respect to changes in the underlying price. This is also sometimes referred to as the gamma of the gamma or Gamma spot. Speed is the third derivative of the value function with respect to the underlying spot price. Speed can be important to monitor when delta hedging or gamma hedging a portfolio. Ultima measures the sensitivity of the option VOMA with respect to change in volatility. Ultima has also been referred to as VOM-mid-vol. Ultima is a third-order derivative of the option value to volatility. ZOMA measures the rate of change of gamma with respect to changes in volatility. ZOMA has also been referred to as TGAMA-mid-vol. ZOMA is the third derivative of the option value, twice to underlying asset price and once to volatility. ZOMA can be a useful sensitivity to monitor when maintaining a gamma-hedged portfolio, as ZOMA will help the trader to anticipate changes to the effectiveness of the hedge as volatility changes. Greeks for multi-asset options: if the value of a derivative is dependent on two or more underlyings, its Greeks are extended to include the cross effects between the underlyings. Correlation delta measures the sensitivity of the derivative's value to a change in the correlation between the underlyings. Cross gamma measures the rate of change of delta in one underlying to a change in the level of another underlying. Cross Vega measures the rate of change of Vega in one underlying due to a change in the level of another underlying. Equivalently, it measures the rate of change of delta in the second underlying due to a change in the volatility of the first underlying. Cross Volga measures the rate of change of Vega in one underlying to a change in the volatility of another underlying. Formulas for European option Greeks. The Greeks of European options under the Blacker-Scholes model are calculated as follows, where is the standard normal probability density function and is the standard normal cumulative distribution function. Note that the gamma and Vega formulas are the same for calls and puts. For a given stock price, strike price, risk-free rate, annual dividend yield, time to maturity, and volatility. Where related measures, some related risk measures of financial derivatives are listed below. Bond duration and convexity. In trading of fixed income securities, various measures of bond duration are used analogously to the delta of an option. The closest analog to the delta is DVO1, which is the reduction in price for an increase of 1 basis point in the yield. Analogous to the lambda is the modified duration, which is the percentage change in the market price of the bond, S, for a unit change in the yield. Unlike the lambda, which is an elasticity, the modified duration is instead a semi-elasticity, a percentage change in output for a unit change in input. Bond convexity is a measure of the sensitivity of the duration to changes in interest rates, the second derivative of the price of the bond with respect to interest rates. In general, the higher the convexity, the more sensitive the bond price is to the change in interest rates. Bond convexity is one of the most basic and widely used forms of convexity in finance. Beta. The beta of a stock or portfolio is a number describing the volatility of an asset in relation to the volatility of the benchmark that said asset is being compared to. This benchmark is generally the overall financial market and is often estimated via the use of representative indices, such as the S&P 500. An asset has a beta of 0 if its returns change independently of changes in the market's returns. A positive beta means that the asset's returns generally follow the market's returns, in the sense that they both tend to be above their respective averages together, or both tend to be below their respective averages together. A negative beta means that the asset's returns generally move opposite the market's returns, one will tend to be above its average when the other is below its average. Fugit. The fugit is the expected time to exercise an American or Bermudan option. It is useful to compute it for hedging purposes. For example, one can represent flows of an American swaption like the flows of a swap starting at the fugit multiplied by delta, then use these to compute sensitivities. See also, alpha, beta coefficient, delta neutral, Greek letters used in mathematics, notes. References. External links. Discussion, why we have never used the Black-Scholes-Merton option pricing formula, Nassim Taleb and Espen Gardehaug, theory, delta, gamma, gamma p, gamma symmetry, vanna, speed, charm, saddle gamma, vanilla options, Espenhaug, Volga, vanna, speed, charm, color, vanilla options, istop, vanilla options, istop, step-by-step mathematical derivations of option Greeks, derivation of European vanilla call price, derivation of European vanilla call delta, derivation of European vanilla call gamma, derivation of European vanilla call speed, derivation of European vanilla call Vega, derivation of European vanilla call Volga, derivation of European vanilla call vanna as derivative of Vega with respect to underlying, derivation of European vanilla call vanna as derivative of delta with respect to volatility, derivation of European vanilla call theta, derivation of European vanilla call rho, derivation of European vanilla put price, derivation of European vanilla put delta, derivation of European vanilla put gamma, derivation of European vanilla put speed, derivation of European vanilla put Vega, derivation of European vanilla put Volga, derivation of European vanilla put vanna as derivative of Vega with respect to underlying, derivation of European vanilla put vanna as derivative of delta with respect to volatility, derivation of European vanilla put theta, derivation of European vanilla put rho, online tools, surface plots of Black-Scholes Greeks, Chris Murray, online real-time option prices and Greeks calculator when the underlying is normally distributed, Razvan Pascale, University of Alabama, Excel-based tool to calculate the Greeks. A free Excel sheet provided by Pristine.